Hi, everybody. Thank you so much for jumping on here. Our intent today is to be able to provide you some content, some information, and answer questions. Of course, if you have any additional questions that we don't answer today, reach out. So today we are very fortunate to have Justin Turner on here. He is an insurance agent that I work with, that I trust, and I know is going to give us some valuable information today. So thank you so much for jumping on here with us today.
Absolutely. Thank you for having me.
Of course. So really, we'll just kind of ask some questions, kind of make it more conversational. And that way we're getting all the content that I get questions on from clients. And hopefully that's giving enough information that will answer the question. So really, maybe if you can just start with the basic, question, what is homeowners hazard fire insurance? And then what is the difference between non-high fire and high fire insurance? Because as we know, there's a big difference.
Sure. As far as hazard fire homeowners insurance, when you're purchasing a house and you see those titles and stuff thrown around, they're all really synonymous terms. They all kind of mean the same thing. So sometimes they'll, just depending on who you're talking to, they'll refer to it as a hazard insurance policy or homeowners policy. But it's essentially they're all essentially the same thing. So it's what you're going to get to protect your home in case something catastrophic happens to it. Obviously, if you're purchasing a home, owe a lot of money on it, and something catastrophic were to happen, unfortunately the mortgage doesn't stop when that happens. So yeah, it's good to have good insurance and stuff that you have in place that'll protect you in case that happens. And of course, the bank's going to want it too, to protect their interests as well.
Yeah. And what would you say is the biggest difference between, and I say normal insurance, non-high fire areas? So somebody that's, buying a home that's in city, that's near fire stations, fire hydrant, not really a big fire hazard because there's not really big trees and open fields and things like that, versus something that is high fire, where it's more rural property, out of area, near, different wooded areas that could be a fire hazard and things like that. What is the biggest difference when it comes to insurance coverage between the two of those?
Well, as far as coverage is concerned, when you get to the high risk wildfire areas, a lot of times we end up having to split up coverage into two separate policies. When a lot of companies don't want to insure in high risk wildfire areas anymore, just because of the amount of catastrophic risk they have to undertake versus what they can collect as far as a premium. Just it's not something that they feel like they can be profitable or even break even on. So in those areas, we end up splitting coverage up into two separate policies. So a lot of people, a lot of people have heard of what they call a California Fair Plan. So that's basically an insurance company of last resort. So you can use those types of policies in those situations. If you can't obtain insurance in a traditional marketplace, you can use that to be able to obtain insurance and get fire coverage where you might not be able to in a traditional market, if that makes sense.
Yeah, and the additional policies, so you would have two policies in that situation. Correct. You'd have the California Fair Plan, which is limited liability if it's in a fire zone, but then you would also carry an additional policy, which is going to be for things like personal property. It's the only way that you could truly be fully insured. Now, from a lending perspective, we usually are only going to require a California Fair Plan, but in order for you to be fully insured, you want to make sure you have both policies. What I've actually come in contact with is I've had some people that have purchased a home and then come to me to, refinance or do another one, and found out that they didn't know that they needed an additional policy. So the lender told them, you only need the California Fair Plan, which is great to get the financing. But if something were to happen and they didn't have the additional policy, then they wouldn't be fully covered.
Yeah, absolutely. So, the additional policy, that's going to cover things like theft, personal liability. Water damage is a huge claim. I got a client in the Bay Area right now with a $200,000 water damage claim right now from a pipe that broke in the house, and it's been leaking for 30-40 minutes, and they finally get home to shut off the water. By then it's into their wood flooring, their kitchen cabinets, and everything's got warped, and they got to rip everything out and start over. So water can oftentimes do more damage than fire. So yeah, it's definitely want to have that second policy. And the second policy on those ones aren't very expensive. It's usually the Cal Fair Plan that's the bulk of the cost. But when you get up into the foothills and other areas, wildfire risk, you have trees as well, lots of trees. So when you have these terrible winters we've had the last 2 years, you get trees that break and fall and hit the house. I have clients with $100,000 plus claims from trees falling and hitting the house, and you don't have that supplemental policy, that's all out of pocket. That could be financially devastating to somebody if they're not insured properly.
Yeah, the crazy winds that we got, that was definitely happening. So that's a good point. Also, I've come in contact, I do a ton of rural property, and I've come in contact recently, and I'm going to be sending out notification to my database too, is people purchase a home, buy land, they have the California Fair Plan and the additional policy, then they build a granny unit. They need to be calling in and changing their coverage to make sure they're fully insured for that additional unit, correct?
Absolutely, absolutely. Yeah, when you have an additional living unit, even just another structure on the house, but especially an additional living unit, that is going to change your insurance policy one way or the other. A lot of companies won't insure an additional living unit on the policy. You actually have to take out a separate policy for that. Some will do it all in one policy, but you still need to add and schedule it onto your existing home policy. So if you've built an ADU or a building one, you haven't done that, yeah, you definitely have a huge gap of coverage for sure.
Yeah, that's the biggest thing that I'm noticing is just people don't realize, you set up the insurance and you forget it. And you don't realize that, oh, if these things happen, I really need to, relook into the insurance. How often would you say someone should review their policy to make sure that they're fully covered? And is there something specifically that they should be looking at to make sure that they are fully covered?
Well, I think anytime you've done any sort of structural modifications to your house, I think that's something you're going to want to revisit. So if you've added on square footage, now if it's something where you're just replacing paint with paint, carpet with carpet, that's not really, you're replacing something old with something new, but that doesn't change the rebuild cost of your house. Now, if you have vinyl linoleum and you're upgrading to $10 a square foot hardwood floors, okay, well, that's a huge quality difference in the type of flooring you have in your house. You might need a little extra coverage if you want to rebuild your house like for like, if that makes sense. And then, solar panels are another thing. If you ground mount them outside, or if you put them on the roof, I mean, obviously once those become part of your property, then there's extra costs in there for rebuilding and whatnot. Yeah, those are definitely things you're going to want to look at anytime if you've done any of those items, or yeah, like you said, adding the ADU or adding on square footage to the house or adding a bathroom, stuff that's going to make the house bigger, more expensive to rebuild.
At what point of a value increase should people be increasing their coverage? Like if they see that their home's appreciating, at what point of appreciation would they need to adjust their insurance roughly, would you say?
I get that question a lot. So we don't insure to market value. We insure to what it's going to cost to rebuild a similar size structure. So I'll use the Bay Area as an example of this. So you buy a 1,500 square foot house in San Jose, it might run you $1.5 million. Doesn't mean that that house is going to cost you $1.5 million to rebuild. It's just a simple average 1,500 square foot house. But because it's in San Jose, that's what drives up the value. So if the house burns down, you still own the land. So there's still value in that land, if that makes sense. So it's going to be similar to rebuild a San Jose house, maybe a little more in San Jose because it's Bay Area and contractor rates are more expensive. But, building a 1,500 square foot house in Sacramento versus San Jose, there's not going to be it's not going to be $1 million in difference and needed coverage for those two houses, if that makes sense, just the location.
Another thing too that I think a lot of people don't realize is the additional coverage that you can get specifically for like guns and jewelry. I know I have some clients, I have jewelry on ours and guns, but I know some clients don't even realize that that's something that they can look into. So if they're doing an annual policy review, if they have a large amount of jewelry or guns or anything of a collection that's in the home, that's something they'd want additional insurance if they need more personal coverage, correct?
Yeah, that's a really good point too. So yeah, if you've made a big purchase or something like that. So if it's just couches, TVs, bedroom sets, there's nothing unique or special with that. That's going to be fine. You don't need to make any adjustments on your insurance policy. What insurance companies tend to limit are small items that are very expensive. So, guns, artwork, jewelry. I mean, you could have a piece of jewelry that big that might cost $50,000. I mean, just depending on how nice it is. So those items, companies tend to have what they call a cap or a limit on how much they'll pay out per piece. So wedding ring's the most common example. So if you have if you're married or engaged and you have a nice piece of jewelry, wedding ring or an engagement ring, that might be something you want to schedule on your homeowner's policy. That way you're getting full value coverage. And that'll even cover if you lose it. So if you're traveling overseas and you forget it in the hotel and forget to put it back on before you leave, it's covered. It's covered even if you lose it.
Did not know that. That is good to know. That's awesome. Yeah. So, I mean, those are just little things that I think people need to, pay attention to. Another thing that maybe you could touch on is, adding a balloon insurance. That
Umbrella?
kind of blankets everything. Can you kind of give just a little bit of what is that and why would you want to consider that at what point?
Yeah, that's what they call it, refer to as an umbrella policy. So it's an excess liability policy. So you have liability in your auto insurance, you have liability in your homeowners insurance. So if the liability claim on either of those policies is extremely high and exceeds policy limits, then your umbrella policy will kick in over the top of that and provide excess coverage over those two items. So if you get in a really bad car accident and somebody's severely injured in the accident, once you hit policy limits on your auto insurance, then that's when, yeah, the umbrella would kick in over the top of that. If you don't have that, then you end up being out of pocket. So if you're a high income earner, if you own a lot of real estate, if you have assets that people can target, yeah, that's when you want to definitely protect yourself. And it's only a couple $100s a year to add on an umbrella policy. They're not very expensive, and it's well worth it in case something catastrophic happens. Now, if you're 25 and you rent an apartment, I mean, there's no point in you purchasing one. You don't really have anything anybody's going to go after. So if you get into an accident, you hurt somebody, they're going to see you don't own anything and you don't really have any money. So they probably won't even bother pursuing you. But if you are successful and you have, build up some assets and you own property, then yeah, you're going to be a target if in a situation like that, if you do get to a bad accident or somebody's injured on your property, because you definitely have something that somebody can go after and obtain for sure. So for a couple $100s a year, it makes sense.
Yeah, it's really
no
cheap.
brainer.
Yeah. And a recent question that I have specifically for you is if somebody has a trust set up, do they need to have their insurance, the trust added to the insurance? I just recently heard that you're supposed to add it to your insurance. I don't have mine, so I'm asking you personally as well.
Yes, you do.
Okay.
So technically the trust is that's who the title of the house is under, but the trust is, it doesn't how do I put this? It doesn't remove you from personal liability. So if somebody's on the property and gets injured and they sue the trust, you're part of the trust. So they're in essence suing you and the trust. So you just list both of you, that both the trust and the trustee on the policy.
Perfect. So I need to do that. And then what would you say? Because, I noticed the insurance premiums obviously will go up sometimes. What is contributing to insurance premiums going up? How often do you typically see them go up? And do insurance claims impact your insurance as well?
Okay. So as far as insurance premiums going up, there's a lot of different things that are going on. Building costs have gone up substantially since COVID. So the amount of coverage that we're quoting on a policy today versus say, July of 2020, we're definitely quoting higher coverages. I mean, homes are coming in with higher amounts of coverage because it's more expensive to rebuild those homes. So that's partly what's driving up the premium. Insurance companies are finally starting to get rate increases approved through the state. And so they're finally getting rate increases that are going through. They have not been granting any of those since COVID started, but you're starting to see those start to come through now. And so that's been impactful as well. And then also when you're more specifically in wildfire areas where you've had a contraction of the market where multiple carriers have just pulled out of certain zip codes and areas, what's left are high-risk wildfire plans that tend to be more expensive than your average policy that you would get. So yeah, those three things are definitely contributing to higher rates. As far as rate increases, and companies can file for rate increase whenever they like. They have to get it approved through the California Department of Insurance, or if it's another state through that Department of Insurance. So they can take a while to get approved. They might file for a high amount. It doesn't mean that's going to get approved at that amount. And yeah, sometimes it could happen as a matter of a few months. Sometimes I've seen them where they take a couple of years to get a rate approval through on certain things. So it just kind of depends. But yeah, companies, pretty much every company out there, if they haven't filed yet, they're going to. And some of them have gotten them through, and I would expect others to start coming through here soon. So the last 2 years in California, claims-wise, have been the worst in the history of the state, not by a small amount, by a very large margin, too. I think State Farm had to borrow $2 billion to cover their losses in fourth quarter from 2022. So it's been very, very bad for insurance companies the past couple of years as far as their losses. And there's a number of reasons why that is. Weather, just stuff is much more expensive to fix now than it was before. But yeah, they're they've definitely tightened the market for sure as far as what they want to consider to take on for new clients. But yeah, those are the main reasons why it's going up. But
How about
I would
claims?
claims,
Claim is
yes,
filed on there.
yeah, claims do impact your premium for sure. It can stay on your record for up to 6 years on home in California. So
And
that
does it follow the person or the property? Because I know that when we're getting insurance quotes and the person selling the home has had a claim, it's impacted the buyer. So maybe if you can touch on that too.
Yeah, it's a good question. So it depends on the carrier. So every carrier is different. Some carriers rate specifically to the buyer, some rate specifically to the property. So I think State Farm rates to the buyer. So if the buyer has had a previous, of course, they're not doing anything in California right now, but if they were, yeah, they rate specifically to the buyer. So if you're moving from one house to the other, they'll look at your previous house and see if there's claims on that and then hit you for it on the new house. Other companies will look specifically at the property. So if you're buying a house and you had one in your previous house, but this house has none, then they'll go off of that house. Some companies do both. So it just depends.
It's been interesting because I track it when I'm getting insurance quotes and seeing the difference. So thank you for clarifying that. What would you say, just a standard homeowners insurance policy, what are some things that are not covered under the policy that you can add, like earthquake coverage and things like that? What are some additional things that typically aren't added? I know that I have people ask about earthquake, but maybe some additional things that don't come with the standard policy that someone might want to consider.
Yeah, earthquake and flood are optional. When I say flood, think of the dam breaking, the river overflowing, tsunami, that's natural disaster, weather related flood or from a body of water. Now, if you have an internal flood in your house, like the pipe breaks, the toilet overflows, that's going to be covered in your homeowner's insurance policy. But external flood is not. So that's separate insurance. And then earthquakes is also separate insurance as well. So those are both optional. They're not required by the lender from my experience. But yeah.
Unless you're in a flood zone, then it may be required that you have flood insurance. But
that's true.
Typically it's not, which is great information. So lastly, what I want to kind of talk about and what I deal a lot with, because I am always there for my clients, even after the closing, is that when servicing transfers, right? So they get a policy, it's in place when we close, they're insured. And now who they make their mortgage payment to changes. They get notification in the mail, and a lot of people throw that mail away and don't pay attention to it. But the servicing transfers, who they make their mortgage payment transfers. And now all of a sudden they get notification that the new servicer who they make their mortgage payment to has force placed insurance because their other insurance policy is canceled. So I get a lot of these calls. I would say a lot, but I get calls on this where it happens and, I take care of it and walk them through. But I kind of just wanted to touch on that because what I'm finding is, and you can, clarify this if not, but when the servicer transfers, they're not updating the insurance policy, which is called the mortgagee information, which is where the insurance agent needs to send the bill to. So you still have the old information, it's going to the old lender. The servicer didn't update that, which they should. It should be a requirement, but it doesn't get updated. So I know that the insurance companies do send out notifications saying that your policy is canceled. What I'm finding is a lot of people don't read that mail. So I wanted to touch on this because I want people to be aware of it. But maybe if you have, any 2 cents on it, and then we can kind of just say, if that happens, then you need to make sure that you call your insurance provider, give them the new mortgage servicer who you're making your mortgage payment to, give them their information so that they can get it updated and then, get it all figured out and taken care of. But what's your thoughts on that?
Well, I probably see 2 to 3 of these situations just with existing clients I have every single week. It's a common problem. I've noticed this with all servicers. I don't know what or what causes this, but when the new servicer takes over, they're supposed to go to update the insurance and say, hey, we're the new mortgagee, please update your records and stuff like that and send us a certificate of insurance. It doesn't happen oftentimes. I'm not sure why. So a lot of times, when policy comes up for renewal, they're sending the bill out to the wrong place. They're sending the bill out to the old mortgage company. I'm not sure what causes that or why that happens, but it is a common problem. So I would tell people is if your loan has changed hands, when you log on to make your payment, I'm sure there's a section there you can check your homeowner's insurance information, make sure they have that on file and it's accurate. So that way, if it's not, they can call them and have them reach out to the insurance agent or reach out to the insurance agent and say, hey, can you please have this updated on the policy. Our company's got really good at that because it's been a common problem. So our company automatically will send out text message reminders to all of our policy holders 45 days prior to renewal. And it'll just say, hey, has your mortgage company changed in the past 12 months? If it has, please make sure that we have that information so we can have it updated on your policy and make sure it's correct. So the invoice and bill gets sent out to the correct place.
Yeah, I'm even taking precautions on my side and sending out notifications a couple times a year, just reminding people, because it's such a, I mean, we all get busy. I know I do it too, or I'll see something I'm like, oh, I'll get to it and then forget. But I think best practice is, like you said, if your servicer changes, meaning they say, hey, you need to now make your mortgage payment to a different company, call the mortgage company or call the insurance provider that you have and just say, hey, my servicing changed. I need to make sure that you have this updated, because it's a nightmare when they force place insurance, which you agree to when you sign your closing documents. You're paying more. Now you have another policy. It's just, it's
crappy
a mess.
insurance too.
Yeah, exactly. And it's a mess. So we want to make sure that that doesn't happen. So I appreciate your time today. I know that you're very busy, so I don't want to take too much. I just always like to provide information. And I think giving an overview of insurance, things to be aware of, things to look out for is really important. And I would say, every couple of years, just call your insurance agent or get another review of your insurance policy and, make sure that you're fully covered and that you have everything that you need updated correctly. But of course, if you need assistance, Justin, I'll put his information out there too. And he's on the screen that we were looking at here momentarily that I'll put up at the end. And, just give him a call. He's great. I've worked with him many times. He's very responsive and he'll be able to help you and give you the information that you need to make sure that you're truly fully covered. And I appreciate you being on here today.
Yeah, thanks for having me.
Of course. Thank you so much. You have a great day.
You as well.
Bye.